Now the second, third, fourth derivatives, we think for every $1 of spend on a GPU, there can now be a multiplier of $10, $12. You think about that multiplier into software, into chips, I believe the AI party has already begun.
Risk, performance, and speculation. We could all agree that Palantir Technologies has been making waves in the tech world lately. With its focus on leveraging data to drive efficiency, Palantir has been a standout in both commercial and government sectors. However, amidst its recent surge in AI-related demand, a new risk has emerged tied to Palantir's share repurchase program. What could this risk mean for PLTR's shareholders? It has been the talk of the town recently as Palantir disclosed a new risk concerning its share repurchase program. This program, authorized to buy back up to $1.0 billion in Class A common stock, has raised eyebrows due to its potential implications. While the decision to repurchase shares might seem straightforward, it's far from it. Factors like market conditions and corporate needs come into play, impacting the program's effectiveness. Moreover, there's a concern that such repurchases could artificially inflate stock prices while reducing market liquidity, which could clash with long-term investor interests. Additionally, diverting funds from other corporate opportunities to stock buybacks might hinder Palantir's financial flexibility and strategic growth prospects. These concerns have led to a hold consensus rating on PLTR stock from Wall Street, with 2 buys, 5 sells, and 6 holds.
So you take a look at Palantir, the incredible run, but Achilles is seeing further growth going forward for the company and the stock.
Yeah, Nicole, I think this kind of fits into the narrative that Achilles was talking about in terms of the bigger picture as well, right? Could see some short-term weakness here, but that underlying fundamental narrative here that's supportive of this rally we've seen is still present here. And taking a look here at the chart, we have seen a little bit of short-term weakness in Palantir.
Analysts from Benzinga have conducted a detailed analysis of Palantir Technologies, uncovering several noteworthy trends. Firstly, the stock's price-to-earnings ratio stands at 260, significantly higher than the industry average by 1.43 times, indicating a premium valuation compared to peers. Conversely, the current price-to-book ratio of 14.9 is notably lower than the industry average, suggesting potential undervaluation. However, the price-to-sales ratio is relatively high at 24.17, surpassing the industry average by 2.16 times, possibly signaling overvaluation in terms of sales performance. Moreover, Palantir exhibits a lower return on equity of 2.8%, indicating inefficiency in utilizing equity to generate profits compared to industry standards. Additionally, the company's EBITDA of $110 million is below the industry average by 0.2 times, possibly indicating lower profitability or financial challenges. With a gross profit of $500 million, also below the industry average, Palantir may face revenue generation challenges after accounting for production costs. Furthermore, the company's revenue growth is experiencing a substantial decline at a rate of 8.99% compared to the industry average of 11.72%, signaling a challenging sales environment. Meanwhile, when considering the debt-to-equity ratio, which provides insights into a company's debt in relation to its equity and asset value, Palantir Technologies stands out among its top 4 peers in the software industry. With a debt-to-earnings ratio of 0.07, Palantir exhibits a stronger financial position than its competitors. This lower ratio suggests a more favorable balance between debt and equity, which is often perceived positively by investors as it indicates lower financial risk. Key takeaways from this comparison highlight various aspects of Palantir's financial performance. While the company's price-to-earnings ratio is high, signaling potentially overvalued stock, its price-to-book ratio is low, indicating possible undervaluation based on its book value. Additionally, the high price-to-sales ratio implies investors are willing to pay more for each dollar of revenue generated by Palantir. However, despite these valuation metrics, Palantir lags behind its industry peers in terms of return on equity, EBITDA, gross profit, and revenue growth, suggesting lower profitability and growth potential compared to competitors. Now, do you remember when Palantir stock surged by 25% in mid-February? That spike was fueled by the data analytics firm's announcement of a significant increase in demand related to artificial intelligence. In particular, U.S. commercial revenues soared by 70% year over year, driven by a substantial 55% rise in customer count and increasing contract values. According to Palantir's Chief Technology Officer, Shyam Sankar, this surge in demand reflects a radical shift in customer expectations for software, with Palantir's AI platforms enabling the seamless integration of humans, software, and AI to swiftly deliver operational outcomes. This surge in demand is propelling Palantir into the realm of high-growth stocks. Before the fourth quarter earnings report, analysts anticipated a growth rate of around 20% over the next 3 years, pegging Palantir's intrinsic value at $13.50 per share. However, with new data suggesting even higher growth potential, Palantir's fair value is estimated to be $19.40 per share, assuming no changes in its business model. Yet, the primary driver of Palantir's performance over the next year will likely be market hype. As an AI-focused company amid AI mania, Palantir stock prices are expected to surge well beyond fair value during this period of heightened enthusiasm. Therefore, betting against Palantir stock might not be a wise move, as market momentum could easily push shares to $35 and beyond, fueled by the ongoing dominance of AI in the news cycle. You see, Palantir has always valued its technology over its sales team. In 2022, the company spent $467 million on sales and marketing, but the revenue increase in 2023 was only $319 million, resulting in a 1-to-0.63 ratio, unlike comparable SaaS firms like GitLab, achieving closer to a 1-to-1 ratio. Palantir's focus on large, customized contracts led to a lack of scalability, projecting only a 10% annual cash flow growth rate in the long run. However, Palantir's products are now practically selling themselves, especially with the rise of generative AI, pushing the company into a breakout story. The recent earnings call included Q1 guidance of $120 million in adjusted operating income, marking a 58% year-over-year growth rate, with potential for even higher growth rates. Analysts are revising their estimates upward, with the average 2025 earnings estimate seeing a 15.5% increase. The influx of corporate clients is expected to change Palantir's business strategy towards a more commoditized SaaS solution, resembling companies like Salesforce or Workday rather than consulting firms like Accenture. These optimistic expectations raise Palantir's fair value to around $25 to $30. However, amidst this optimism, there's a risk of the market overhyping the AI narrative, similar to the EV hype of 2021. Despite some AI companies' valuations exceeding their fundamental values, Palantir might also experience a surge in its shares due to being in the right place at the right time. With the ongoing AI wars and concerns over data privacy, Palantir could see its stock price soar, even beyond $40, driven by the prevailing AI mania. But before we move on, we just want to thank you for watching this far. But it's important to note that HSBC recently changed its rating on Palantir from a buy to a hold while maintaining a price target of $22 per share. This downgrade seems primarily driven by concerns about the company's valuation, which analysts perceive as rather high. Despite recognizing Palantir's strong growth in the commercial sector, especially in the US due to increased demand for its AI platform, analysts are cautious about the stock's price-earnings to growth ratio, which stands at 3.2 times for 2024, suggesting a potential need for consolidation. The debate over whether Palantir is overvalued or a worthwhile investment at its current price hinges on one's time horizon. While the company's growth has been propelled by the adoption of AI, some investors believe that its valuation is justified by the significant potential for further growth. However, others remain skeptical, emphasizing the need to assess both the risks and opportunities associated with investing in Palantir stock. Given the current uncertainties surrounding Palantir's future earnings and revenue growth, some investors may prefer to wait for a pullback before considering an investment. While the outlook for Palantir stock may be cautiously bullish for some, it's essential to carefully weigh the potential risks and rewards before making any investment decisions. What's your take on Palantir's valuation and growth prospects? Share your thoughts in the comments section below. And that's it. Make sure to smash the like and subscribe buttons down below. Additionally, if you want to know about Palantir, just click this video right here. Thank you for tuning in, and stay tuned for more exciting content in the future.